Hey guys, and welcome back to Sloth Finance. My name is Zach, and today we are going to be looking at QYLD and the passive income it generates. So today we are going to be examining QYLD in my Robinhood portfolio. If you like the content or are feeling generous, smash the sub and like button. After listening to this video and doing your own research, if you want to start your investing journey with Robinhood and like free money, I'll post my referral link below. Without further ado, let's get into the video. So over the creation of QYLD, it is down around 33%. Makes sense. It's a depreciating asset. If you don't understand that, just stick around and that will be explained. So I have around 227 shares. The market value of that is around $3,800. My average buy-in is at $1,817. So my total return, I'm down around $340, but Robinhood does not take into account your dividend payments for the total return. So I've made around $200 in the passive income. So I'm only down around maybe $140. And I think QYLD, if the market recovers, I think it could go back up to around $20 before continuing the journey back down. So let's take a look at what is the primary income source of the fund. It is primarily a technology hold, and you can see that the 21-week high and low. The week high is $21 and the week low is $15. If I had to make a guess at where we're heading, I would say it's probably going to dip more around the $15 range sooner than later, and then eventually recover maybe back to around $20. So let's look at our dividend payment and how the passive income works. So the fund, the ETF, usually generates, I believe it's somewhere around the 17-cent or 20-cent range per share. And you can see how the natural growth occurs when you're getting around $30 in a dividend payment. My first payment was $33. Then because this ETF pays monthly, you can kind of see the natural progression in the dividend snowball. However, if you take a look at the August payment to the September payment, you're like, well, how is the September payment lower than the August payment? Well, that's because QYLD fluctuates in its payments. So it is possible for your dividend payment to be lower one month and then higher the other. So we're going to be looking at a couple articles about QYLD and kind of break down how it works, the stigma associated, and who it's for specifically. And then at the very end, we're going to be looking at some technical analysis to see where I think it's going to be headed in 2023. So if that sounds exciting to you, stick around and wait to see. All right, let's talk about the specifics surrounding QYLD and how exactly it works. It has $6.7 billion in assets and is an ETF from Global X that holds assets in the NASDAQ 100. Now, we're on the Global X website, and it breaks down kind of how it works and is generally some good information, and I'll link this article in the description. The way it generates income is by selling covered calls on the NASDAQ stocks. So, in this article, we'll break that down further. So, the covered call position is created by buying the stocks in the NASDAQ 100 and selling a monthly at-the-money index call option. An option is a contract sold by one party to another that gives the buyer the right, but not the obligation to buy or sell a stock at an agreed upon price within a certain period or on a specific date. This is why, if you're familiar with economic news, you hear, oh, well, on Friday the options expire. In return for the sale of the call option, the fund receives a premium, which can potentially provide income in sideways markets and limited production in declining markets. So let's go through how the cover call writing process occurs. Step 1. QYLD buys all the equities in the NASDAQ 100 index. QYLD then sells the NASDAQ 100 index options to a counterparty that will expire in 1 month. This is usually on a Friday. A premium is received in exchange for the sale of the index options. At the end of the month, QYLD seeks to distribute a portion of the income from writing or selling the options, and this of course goes to the shareholders. And then at the beginning of each new month, this process is repeated. So here's some basics that it breaks it down. Let's break down the index option basics. They expire at the end of the month. Unlike single stock options that can be exercised at any time, the index options cannot be called or exercised early. Higher index volatility can lead to larger premiums. This is one of the riskier stock option moves, and a lot of it has to do with volatility. And it's one of the reasons why I think people who are into options have moved to crypto. It's because the volatility is just so much wider. If you trade the smaller time frames, you can get these couple percent pumps a lot easier and make more money. If there are gains from writing calls, they are taxed at 60% long-term capital gain rate and 40% short-term capital gains. Alright, let's look at a couple scenarios. The first one is a down market. The NASDAQ 100 index ended the month below the strike price. So QYLD, which sold the call option, would potentially benefit from the premium received. This may offset some or all the decline in the underlying equity. So obviously the line is where we bought, and the black line is the price fluctuation for that month. Now let's look at a flat market. If the index price has not changed at the end of the month, QYLD keeps the money it collected from selling the monthly index call, and the fund still owes the underlying equities. Now an up market. If the index price rises at the end of the month, the potential gain will be limited since the fund sold a call option at a predefined strike price. As the index rises above the strike price, the fund still keeps the money collected from selling the monthly index call option, but won't benefit from the entire increase in the index value. This is one of the downsides of QYLD, and we'll delve deeper into this into the next article. Here's a 12-month distribution of the dividend distributions that you get per share. So as I mentioned earlier, the price fluctuates, and it looks like it fluctuates between 20 and 25 cents. The last month distribution was around 17 cents. Now, the article goes on to try to provide evidence based on why it has a measure of protection. And of course, this is by Global X, so they are biased. So their first proof is this is how the QYLD is protected in the downturn. It goes on to state that the NASDAQ 100 has actually suffered worse in times of economic distress than QYLD. And while that could be true, the NASDAQ 100 has performed worse at certain times. If you look at the total big picture, that is not going to be true. Total big picture, QYLD will perform worse than broad-based index funds. So what are our kind of conclusions from this article? All right, let's take a look at the 3 reasons on why QYLD is primarily for retirees and not growth investors. So the first reason is kind of a trickery with the distribution. So the distribution yield includes a return of capital. The true yield is lower. So what does this mean? This means that the yield is lower than people think because people assume the return of capital means return on their investment. However, it could mean no new income is generated and the money you initially put into the investment is just being returned to you with no gain. And this is showed in this October 2021 distribution call. You can see that only 1% of the net investment income, while 98% was return of the capital. Now, does this happen every year? No, of course not, because if they just returned a primary portion of the capital, that is not a sustained business. Now, if you jump ahead to June 2022, you can see that the net investment income was 2%, and the net realized capital gains was 97%, with 0% being a return of capital. So obviously that was just for 2021 and not throughout the journey of the ETF. Let's get to reason 2, all the risk with capped upside. Now, newer investors see over the 10% yield and dismiss the alternate facts. They are, with high yield comes a price, and that is the total return, which is capped because the profits are sold in the form of the income distribution. Now, the stipulation that QYLD is protected from downside as it is capped at the upside, and this is just false. QYLD has never been in a bear market or recession, so there's no data to go on how it will do. Now, if we look at this portfolio growth chart, you can see 3 things were invested: QYLD, QQQ, and a Vanguard high dividend ETF. If you invested $10,000 near to 2013, 2014, and let the money stay in that account until 2022 or 2023, you can compare the final balance. QYLD was the worst performing by far. However, this does not take into account the dividend income. If you compare the values, it shows that the best year of return for QYLD was 22.7%, while QQQ was 48%. So that goes back to what we were saying about how it's capped on the upside. For the loss, the max loss was 17%, while the Vanguard fund was 24%. So we lost about 26% on the upside because it's capped. Now you could say that, well, it didn't lose as much as the Vanguard fund, but that was only a 7% difference. And the third strategy is really one that I'm not a big fan of that they talk about in this article, and that's how to replicate what QYLD does with an ETF like QQQ. And I'm not going to really get into that a lot because it's for investors that have been around or more experienced, and not really what I want to get into right now. So, the last thing that I want to talk about today is the technical analysis of QYLD and where I think it's going. We've discussed the pros and cons, the pros being it's a great passive income source. It has that 12% dividend, which we kind of broke down, which is less. It cannot be taxed as a dividend. And the cons are, obviously, it's a depreciating asset. We don't know how it's going to perform in the bear market. And my conclusion is that there's really no reason to dollar cost average into it unless you know you won't have a lump sum for retirement. But I think it makes more sense to put your assets in more growth related until you're dependent on a monthly income. and you need that from QYLD or as an alternative, RYLD or JEPI for that matter. So if we look at the chart, we can see that this ETF has bounced fairly well from previous all-time lows. Like in 2018, we hit a low and we bounced about 23%. Then with COVID, we bounced about 35%. Now, using COVID as a data point is not a great idea because I think that was a one in a lifetime experience. And then the last bit of technical is that sitting around this 15.7 area is a lot of support. So I expect the graph to go down to around 15.7 area and bounce. I think we'll bounce lower than 16 or 17, maybe 16.5, and then I think we will continue lower. So my final thoughts for this video is I think I will keep my position in my Robinhood portfolio for the time being, because I expect some recovery in maybe the next couple years. But with that being said, I probably won't put any more money towards the position, and I'll probably be looking to sell and put in more growth to have my money better serving more growth opportunities until I really need the passive income, which I currently do not. If you liked today's video, hit that sub button and